Welcome to the All Things Financial podcast. Today we're going to talk about everyone's favorite topic, taxes. You've worked your whole life saving for what you have, and now you have to wonder how much of it do you actually get to keep. We're going to talk about taxes and more in this episode. Stay tuned.
Welcome to All Things Financial, Trey Peterson and
Yelisey Coots.
And today we're talking about probably one of the most important things in retirement.
Yeah.
Taxes. How do you pay all the dollars that you owe, but not leave a tip on the table? And today we're going to talk about some of the strategies around maximizing what you've worked so hard for. How do you make sure that when it comes to pensions, Social Security, brokerage accounts, traditional IRAs, SEP IRAs, 401ks, 403bs, 457s, and the whole alphabet soup, how do you make sure that you take your investments in a way that you're paying everything that you owe, but again, that you're not making any common mistakes when it comes down to a withdrawal order and pulling from the right place at the right time. So if you think about it, you've spent your whole life, I should say, accumulating, and now you're coming into where you're going to be spending or deaccumulating. And today we're going to talk about some of the key things that you can do to maximize what you've worked so hard for.
Yeah, I think there's this huge misconception. People think that once I get to retirement, that's when the tax-free income starts. I think that there's this weird kind of progression from working in the working years all the way until you get to retirement, and then eventually, whether it's Social Security or whatever the sources of income are. And I want to emphasize, the sources of income that you have and the order that you withdraw from those sources, that's what determines your tax bill in retirement.
Yeah.
One of the first things we're going to talk about, and I think that Social Security is a huge part of the conversation, specifically in 2025 based on the One Big Beautiful Bill. But just in general, Social Security represents a huge source of income for people. And there's a lot of conversation on whether or not Social Security is tax-free. And I think part of what kind of muddies the conversation a little bit is, we're talking about federal income taxes, but there's also state income taxes. And even though federal income taxes are kind of across the board, they apply to everybody, but not every state does it exactly the same way. So we're going to focus on federal income taxes in this episode. But yeah, there's a lot of confusion on that. What's your take on Social Security and taxes and what clients have said to you?
Well, I think one of the things that we see, so we teach, 50 to 60 some financial classes a year across our team, whether it's Social Security, Medicare, tax and retirement. We talk about estate planning, all these different topics. And I think one of the things that people don't understand is that Social Security is as important as a pension. And I think a lot of people assume that your Social Security is just something you turn on as soon as you retire, and there's no strategy around it. And one of the things I think we do a great job is educating people on the importance of understanding that there is a strategy on Social Security and that you should take it as serious as you take a pension or your other, retirement accounts. And so when it comes to that, it's not clear, meaning that not everybody pays the same amount of taxes on their Social Security. There's a lot of what we would say is, depending on how you do things, there's a lot of variations of you pay no taxes, a portion of it's taxable, and then based on something called provisional income, that determines, based on your income sources, what percentage of Social Security is taxable. And so the biggest thing I think we do a great job helping people with is looking at how does taking this at the right time, short-term, mid-term, and long-term impact me. And a lot of the times what we say when it comes to Social Security is it's not a me decision, but it's a we decision. Are you thinking about your spouse? Are you making sure that if one of you passes away early, that the survivor is going to be okay? And are you looking at it as part of your retirement plan instead of as a separate item?
Speaking of Social Security and taxation specifically, people actually don't realize it wasn't always taxable. So in 1984, when Ronald Reagan was the president, that was actually the first year that Social Security itself was taxable. And at that time, only up to 50% of your benefit was taxable. Fast forward a decade later, under Bill Clinton, we actually, it bumped up to 85%. So up to 85% could be included in your taxable income. So it wasn't always the case. And it's based on something just like you mentioned, provisional income. So Congress had to determine how are we going to decide how much of each person's benefit is taxable? So they gave us these provisional income thresholds. The problem is when those thresholds were first introduced in the 80s, and then again, they were updated in the 90s, they've never been indexed for inflation.
Right.
So what it means for us, effectively for clients, it just means more of your Social Security benefit is getting dragged in. It becomes part of the income equation because those thresholds have never been updated. Anyways, a really simple way to remember it is, if the only source of income you have is Social Security, you're probably not paying any federal income taxes, but then you introduce a pension. Maybe you eventually get to the age of 73 or 75. We'll talk about RMDs. And maybe those sources of income, or maybe you get bored in retirement and you get a part-time job. Now you're introducing other sources of income, and those other sources of income are what cause Social Security to become taxable.
Yeah, very good. And I think high level, if you've never had anybody run a Social Security report showing you when to draw your benefit, how to take it, based on your other income sources, what percentage is going to be taxable, we'd be happy to do that for you. You can reach out to us through the podcast, through going to ATF, which stands for allthingsfinancialwealth.com, atfwealth.com, and we can do a Social Security analysis for you. So the big thing, if you're taking notes on Social Security, that determines how it's taxable is provisional income.
Yeah.
So let's go in. I know we've got a little bit of an order, but I think one of the things that we talk about is order of withdrawals. And so when we talk about order of withdrawals, what we help people with is determine where do you pull money from in what order. And almost all of the, PhDs in math and, the CPAs agree that typically we would start with your brokerage account, checking, savings, really non-qualified, non-retirement accounts.
Yeah.
Then we'd move into pre-tax, whether it's an inherited IRA or your own IRA, and then Roth is last.
Yeah.
And so I think if we kind of follow that format, we think about it. If you start with your brokerage account, the reason for that is what? Why would we start with the brokerage account instead of spending the Roths first or the IRAs first? What would you say to those people asking that question?
Yeah, so your brokerage account is going to represent maximum flexibility, because within your brokerage account, you might be exposed to all different types of taxes, right? You might have some investments that are short-term investments, and those are going to be taxed at your ordinary income rates. You might have some investments that you've held for a year and a day, and then those get long-term capital gains treatment. You might have some interest or dividends that are generated from those accounts. Well, those are going to be treated differently depending on how long you've held the investments as well. So you have a lot of flexibility if you're really trying to mitigate taxes and just have some control over your tax brackets. You move on to your pre-tax accounts, your IRAs. Well, those are all going to be taxed at your ordinary income rates. Every dollar you pull out of there, taxed exactly the same.
Right.
And then you move on to your Roth, which is tax exempt. So I would say that for most people, that order that you mentioned, that's exactly the order that we look at. But also we do a lot of forward thinking. We make projections. We know that maybe 5 or 10 years from now, you have this giant RMD. It's kind of hanging in the distance. And
RMD is what again?
Your required minimum distribution.
That's right.
So sometimes rather than taking from the after-tax accounts, right, your individual, your brokerage account, sometimes you might intentionally pull from an IRA to fill up, let's say, the 12% bracket.
Yeah.
So we can lower that required minimum distribution in the future.
Yeah. So if we're talking about non-qualified pre-tax and then Roth last, one of the other mistakes that we see a lot of people make is their advisor will show if you need $6,000 a month, we've seen where they'll say you're going to take $2,000 from the IRA, $2,000 from the non-qualified, and $2,000 from the Roth.
Yeah.
And while it looks like it's balanced, it actually doesn't make sense.
Yeah, it's just some weird things. Like sometimes, we've talked to clients. We've even had clients who've talked to their advisor on the phone with us in the room, and they're saying silly things that are like they're making their decision based on the balance of the accounts. Well, why don't we pull from this one? That's the largest account. Like that shouldn't even be part of the conversation.
Yeah.
Or sometimes it's just like, hey, well, why don't we pull from this account? Well, because that one already has a link to your bank account. We'd have to set up instructions for the other account.
Right.
So that's not part of the conversation, right? So it's important to, sequence of returns, sequence of distributions. Those are all important conversations to have in terms of taxation.
So one of the questions to ask your advisor to help you determine if you have what we would call as a retirement planning specialist compared to a generalist is what is your strategy on where I pull from and in what order?
Yeah.
And I think listening to the answer is really important. And then does it line up with what we just laid out? Non-qualified, pre-tax, and then Roth. The other thing that we see a lot of mistakes is a lot of people, depending on their risk tolerance, they not only have their household set up at a certain risk level, but they have each investment. So what is that? They might have a brokerage account, an IRA, and a Roth. And if they're in a 70-30, which is 70% equities and 30% bonds, what we find is that all three of those accounts are 70-30. When really, if you think about it, even if you're a 70-30 as a household, you should have your Roth be all equities. You should have more of the safe stuff in pre-tax dollars, maybe non-qualified dollars if you're spending it first. And so it's really important. One of the ways that you can determine if you have a generalist or a specialist in retirement is, are all of your accounts invested at the same risk tolerance, or do they have the bonds in specific portfolios based on the timing of when we're going to use it?
Yeah.
And one of the ways you can determine that for those that are going, hey, I want to know, is look at your statement. If there are bonds in your Roth, it's very likely that your advisor is not a tax strategist. Is that a fair comment?
Right. Yeah. And I would say, there's obviously exceptions to every rule. Like we actually ran into someone the other day where they had a 1.5 million in Roth IRAs.
Right.
Now, obviously rare, which is very rare. No one, most people don't have that much in a Roth IRA because most of the time people like to contribute to a 401k or an IRA where they get the tax deduction in that year. You don't get the benefit in the year you contribute to a Roth. The benefit is in the future, later. So this guy had 1.5 million. And of course, when you have, the majority of your retirement savings in a Roth IRA, you're going to find some bonds in that Roth IRA because they have a well-diversified portfolio. But more often than not, we find what you're saying, huge mistakes where people have very risk-averse investments in their Roth. Sometimes they have investments that are generating interest and dividends in their after-tax accounts, and they don't need the additional income. And they're wondering why every single year they have $10,000 to $20,000 or $30,000 in income that they don't even see.
Yeah,
those dividends are just simply being reinvested, but they have to pay taxes on those dividends. So for some folks, it's a matter of locating the right assets in the right accounts.
The other thing I've noticed is there's kind of two key things that we see a lot of people miss when it comes to retirement planning. The first one is they don't realize that the tax brackets don't change just because you're retired. Right. So number one is they don't realize that all those pre-tax dollars are going to get taxed at ordinary income rates. The second piece to that is a lot of people don't understand that we have a progressive tax system. I was sitting with this couple and I was explaining to them, even though you guys are going to be in the 24% tax bracket most of your retirement, you're in the 10%, you're in the 12%, you're in the 22%, and you're only like $3,700 into the 24%.
Yeah.
So one of them, she understood that it was progressive, meaning that their effective rate was like 18%, even though they're in the 24% tax bracket.
Yeah.
But he thought that just because we hit the 24%, now all of those dollars were taxed in the 24% tax bracket.
Yeah.
So I think one of the things that people need to understand is that we have a progressive tax system, and based upon where you pull money in what order determines your tax bracket, especially in the beginning years. And then the third piece to that would be the required minimum distributions.
Yeah.
So one thing I hear a lot when we talk about required minimum distributions, and I'll ask people, what has been your plan with your current advisor or on your own? And they'll say, well, I'm 3-4 years from retirement, or I'm 6-7 years from retirement. We haven't talked about that because we're so far away. I would say that if you're within 7 years of retirement and you have not started planning for required minimum distributions, you're behind. What would you say to that?
I think people have this weird idea. It's not a weird idea. It's what they tell everyone, right? Contribute to your 401k today, and then eventually you get to retirement and you're going to be in a lower tax bracket. You'll be able to take the money out at a lower rate. And what you find is a lot of times people don't end up being in a lower tax bracket. And those RMDs really, they kind of come as a shock. And there's really some huge consequences. Really the thing that you're trying to avoid in retirement, you're trying to control your adjusted gross income. There's so many things that are based on your adjusted gross income. Like for instance, we've had some people that their RMD is forcing more of their Social Security to become taxable. They didn't need the RMD. They don't need the additional income, but they're forced to introduce it. So now more of Social Security is taxable. We've had some people that their RMD is forcing their AGI to limits where now they have to pay more for their Medicare premiums. We have some people that used to itemize where it's like, hey, all of my medical expenses that are above 7.5% of my adjusted gross income, I get to take those as itemized deductions. What happens if your adjusted gross income goes up? Well, that threshold for those healthcare deductions also goes up. So you might not be able to take advantage of healthcare procedures that you've had and those expenses. So there's a number of things. You might be phased out of long-term capital gains. Maybe you're no longer in the 0%. Now you have to pay 15 or 20% based on that additional income. So here's what I want to say. Income's a great problem to have, but if you don't manage it, if you don't plan for that RMD in those earlier years of retirement, you might be dealing with some challenges in terms of managing that bracket that has some consequences that, if we were to spell that out and lay it out for you, you might not be comfortable with that. It might encourage you to do some planning in the early 60s, where most of the time people think I have all the time in the world, RMDs are a decade away, but really you have to do the planning 5-10 years before in advance so that they're not a surprise for you later.
I would say too, I sat with a couple yesterday and they said, we've been with this really large broker for a long time and we like our guy, but one of the things they promised us was education. Yeah. And they said, we've gotten very little of that past when we made the decision to work with them. Mm-hmm. One of the things I would tell everybody is that nobody cares more about your money than you do. Yeah. And one of the things that we work really hard to do is not make things complicated. Our goal is to make things simple. And I was telling this couple, if you could just pick up one thing every time we meet, that's what winning looks like. Right. And one of the things I always work really hard to do is put things in terms that if finances are not your background, instead of getting in your car and looking at your spouse going, do you have any idea what he said? No, I don't know. I guess we need him because he's really smart and we're not. That's not our goal. Our goal is to break things down in a simple way so that when people come in, every time they leave, they have a better understanding of either Social Security, investments, the insurance that they have. And I think if you can just learn one thing every client strategy meeting, now you're learning more about the things that you didn't understand, and it actually helps you better steward all the money that you've worked so hard for. Yelisey, one of the questions that we've been getting a lot is around the big, beautiful bill. It's so interesting because I don't know that I've ever heard more confusion from something.
Yeah.
And one of the things that we've learned, not just with the big, beautiful bill, but really with any big changes, is anytime there are changes that come out, the first people that read it interpret it different ways. And so not only does it come out and people start announcing what's in there, but then there's like this time that it takes for clarification from judges to say, well, here's what we meant when we said that. So in the big, beautiful bill, what is one or two things that we've had people come in and say, hey, I heard this. Is it true? Is it not true?
It was a very weird thing. So in 2025, there were things that were like, hey, this is a proposal, and then suddenly it's not. Suddenly, like, this is actually the rule. And one of the biggest things that there's a lot you could kind of point to, but in the context of retirement, one of the biggest things that affect many of our clients is the additional temporary senior tax deduction. So basically, there was a lot of messaging on Social Security, whether or not it would be taxable. And ultimately, Social Security is still taxable, but in a roundabout kind of way, because of the temporary senior tax deduction, you might end up paying less in taxes on your Social Security benefits. And the way that it works is they gave everybody an additional $6,000 standard deduction. So imagine you take the standard deduction, just add $6,000 to it. But there's a couple caveats. You have to be 65. You don't have to file for your Social Security benefits. In fact, it's not related to Social Security. You just have to be 65. Oh, and your income has to be below a certain threshold. So if you're single, that threshold is $75,000. If you're married, it's $150,000. So if you meet that criteria, the age requirement and the income requirement, you get an extra $6,000. And by the way, like they talked about this as a proposal in 2025, it applied for 2025. 2025 was the first year. So now the reason why it's temporary, we have 3 more years of the temporary senior tax deduction. And like, it's kind of a big deal because if you're managing your brackets, you get an extra $6,000. If you're married, $12,000 that you can add to the 12% bracket. Maybe for you that represents Roth conversions, which we're going to talk about in the next episode right after this. So it's a big deal. And I think it affects a lot of people, especially those in and nearing retirement. And then the other thing is they gave us a very generous phase out. A lot of times your income like goes above a certain limit and it's like, sorry, you phase out. You don't get that tax credit.
Right.
You don't get that tax deduction. With the temporary senior tax deduction, they gave an additional $100,000 to fully phase out. In other words, if you're single, your income has to be above $175,000 or $250,000 if you're married to fully phase out of that. Now, of course, you want to capture as much of that as you can. Just know that you do have a generous phase out income limit on that.
So one of the things that we say, just kind of wrap up on tax and retirement, one of the things that we see often is people have an advisor that manages funds. They have a tax preparer or they do their own taxes because it's simple. Maybe they've got a couple W-2s and some farm income. But a lot of times what we see is people are missing the tax strategist, kind of that person in the middle that says, we don't just prepare or prep taxes. We don't just tell you what you should have done last year. We actually put together a strategy showing you what you need to be doing to help yourself in a year, 3 years, 5 years, and down the road. If somebody's never had a tax strategist look at their overall retirement plan, one of the things that we're known for is that we've got you, we've got Matt, we've got other tax professionals on our staff. And what we help people do is not just prepare what they did last year and point out the mistakes they made, but we help them prepare for the future.
Yeah.
If you've never had a tax analysis and you want to sit down with somebody that specializes in retirement and tax strategy, we'd love to do a complimentary spend down plan for you to show you the areas that you can save. Thank you for joining us today on All Things Financial, where we help you retire once so you can retire well.
Advisory services are offered through CG Advisory Services, LLC, a registered investment advisor, and through Guardian Wealth Strategies, LLC, a registered investment advisor. CG Advisory Services, LLC, and Guardian Wealth Strategies, LLC, are separate and unaffiliated entities. The topics discussed on this podcast are for educational purposes only and are not intended to be investment advice or recommendations. Listeners should consult with their own financial professionals before making any investment decisions.